Welcome to Inside Tax Policy. I'm Pam Olson. We're coming to you today from sunny Orlando, Florida, where PwC is hosting its annual Tax Leadership Conference. Joining me today to talk about the global reaction to U.S. tax reform is Will Morris. Will, a frequent guest on Inside Tax Policy. Good to have you here with us.
Thank you very much, Pam.
Let's talk about what you've been hearing most recently about the reaction of other governments to the tax reform law, which is almost a year old now.
That's right. So it continues to evolve. I mean, there's always a point at which I tell my favorite chow and lie joke, which is when asked about the effect of the French Revolution, I said it's too early to tell. There is still an element of that. Countries are still figuring it out. And particularly as they themselves wait to see what regulations come out, they're trying to figure it out. But I think it's one of these things where everybody's looking at it, and everybody says it has an effect. Now, the trouble is that when something becomes, in those terms, if you will, iconic, that icon can be used for different purposes. So some people hold it up as something to follow. Other people hold it up as an example of how the US, always tries to have its own way. And other people say, well, there are good bits in here and there are bad bits in here, but we need to figure it out.
Okay, and so that's still settling out.
Yeah.
One of the things that we've heard a lot about recently is that the OECD's Foreign and Harmful Tax Practices was asked to look at the FDII, or Foreign Derived Intangible Income provision in the bill. Do we know what's the latest on that?
Well, they've managed to keep that relatively quiet. We do know that the US went and talked to them. We do also know that the US doesn't view this as being the last step in this process, and in part because, yes, the regs aren't out. And I think the US has made a convincing case that just based on the face of the statute itself, it's impossible to tell exactly what all the nuances are going to be. So I think that we would expect them to come back, probably in 6 months' time and take another look at it. But the interesting thing is that that's actually not the only place where the OECD has been involved in this process, because there's another of the working parties, Working Party 11, which deals with some other aspects of BEPS. And a number of countries have come there and they've said, so this is the anti-avoidance working party effectively, and they've said, we've been trying to apply our anti-hybrid rules, and we wonder whether payment into a GILTI regime actually qualifies. And as you know, as everybody knows, it's a little hard to tell that. Is this a straightforward CFC regime? How do all the expenses work out? All the rest of that stuff. But again, it's an interesting example. We've heard this in relation to not just the OECD, but the WTO, the European Union, all those types of things. Is there a way that we can use these international organizations essentially to advantage our own fiscs against the US? And clearly, going to ask the OECD for some type of ruling, which I think is highly premature, by the way, on whether this is a good CFC regime or not, and therefore whether their anti-hybrid rules should be turned off. But again, it's an example of people using international organizations to try to gain some advantage.
Yeah, governments using it, and other governments seem to do it much more effectively than the U.S. does. But maybe I'm just expressing a U.S. point of view there.
Well, you may be, but that doesn't necessarily mean it's inaccurate.
Yes. So at the OECD, there are other things that are going on, or it has been suggested that other things should be going on with respect to U.S. tax reform. And in particular, one of those is the base erosion and anti-abuse tax, or BEAT, which it has been suggested should be referred to the OECD for the OECD to take a look as well. Now, that's another one where we're still waiting for regulations, though those may be close, so maybe it's hard to evaluate until we see the regulations. But when we think about the reaction to GILTI, the arguments that are going on at the OECD would suggest that GILTI isn't a stiff enough tax, which is, of course, not the reaction of most of our clients who are experiencing it. And BEAT, what do we think might happen there?
Well, again, but let me just come back to GILTI for a second, because I think that's important. When we look at what happened during BEPS, there was meant to be a trade-off from the anti-hybrid provisions on the one hand and the CFC provisions on the other hand. They're almost, one's Action 2, one's Action 4. And the US thought there was going to be that deal. Most countries did not want to strengthen their own CFC regimes to do this. So there is no little irony, as they say politely, in countries saying, well, your regime isn't quite strong enough. You think, we don't even have a regime. Or, the one that the EU is just about to make you put in place. So anyway, That's just sort of by the by. But when it comes to BEAT, again, obviously there are issues which are being raised about non-discrimination and all the rest of these issues. These are issues which, when you look at what other countries have done, and let's broaden this out to, of course, my favorite space, which is digital. When you look at what some of the countries have done in digital, you think, how did they get away with that?
Right.
And the answer is, they say, oh, that's not an income tax.
Yeah, yes, right. So we had the same thing with the diverted profits tax in the UK, right? And I think from what I've heard, at least Treasury's view is it's too early to take a look at any of these issues. We need the regulations first. But in addition to that, we probably need to finish the discussion on digital. And in addition to that, if we're going to take the US in, then we're going to take in some of these other taxes. We're going to take in the DPT, we're going to take in the digital service tax, we'll take in them all and ask the same kinds of questions with respect to them.
And I think that's very sensible, clearly. I think one of the things which happened during BEPS is that the US got constantly sidelined. And that was the way the process was set up. I think to say, look, you can make any arguments you want to, but just be aware that we can make any arguments we want to as well, I think is more effective. One of the difficulties is countries have sort of, again, over the past 6 years, because the US, again, the way the process was set up, nothing about any of the individuals involved, because the way the process was set up meant that the US essentially got pushed aside. People have gotten less used to listening to the US. And I think that one of the things that this Treasury is trying to do is to up the volume on that. And I think that's a really helpful thing for US business. But it'll take time to change that attitude.
Okay, so 2 final points.
Sure.
WTO, we've heard a lot about the fact that some of the parts of US tax reform, FDII in particular, might not be consistent with WTO rules, but nobody's challenged us yet.
No, not yet.
Okay, maybe they're waiting for the regulations as well before taking that forward, but and maybe there's too many other things going on the trade side.
Right.
Okay, so the last question is about digital and what's going on with digital,
right.
Because it seems like one of the items that might be on the table looks a bit like guilty.
Well, a bit looks like guilty and a bit looks like beat. So, I mean, there are a bunch of things going on there. And this is why, I mean, it's fascinating, for political junkies, but it's actually quite important as well. So there's a guilty type thing, so there's a possibility of a minimum tax, and there are various flavors of what the minimum tax can be. But there is also the possibility of moving towards a more destination-based system, and whether you get there by allocating more income or by denying deductions, in a sense, is neither here nor there. So you get something which looks more like beat. So as countries come to talk about this in the OECD process, conversation, whatever you want to call it, over the next 6 to 12 months, a number of these items are going to come up as well. And I think that's one of the reasons why the OECD itself is not anxious to bring any of these issues to resolution, because they might be there themselves very shortly.
Indeed. So we may, at some point in the not too distant future, have an episode about how I learned to love the beat.
There we go.
And guilty.
And guilty.
Okay, Will, thank you so much for joining us here today, and thank all of you for watching Inside Tax Policy.